Right now, there's more silver being traded on paper than actually exists in vaults. And that gap keeps getting wider. Here's why that matters. So look, imagine this. You buy a concert ticket online. Transaction goes through, you get confirmation, everything looks legit. But when you show up, the venue only has half the seats that were sold. That's basically what's happening with silver. Except the stakes are way bigger and almost nobody's talking about it. The paper silver market, futures, ETFs, derivatives, it's massive. We're talking hundreds of billions in trades happening every single day. But here's the thing. The actual physical silver that backs all those trades, the real metal sitting in vaults, that's not growing at the same rate. Not even close. And this gap between paper claims and real supply, it's creating pressure that most people don't see coming. Get this. Industrial demand for silver has been climbing for years. Solar panels, electronics, EVs, medical equipment, all of it needs silver. And it's not optional silver. It's a critical component. You can't just swap it out. But while industrial users are pulling more physical metal out of the system, the paper market keeps expanding like nothing's changed. Those two realities don't line up. Here's where it gets weird. Most people who trade silver never touch the actual metal. They're trading contracts, shares, digital claims. And that works fine, until it doesn't. Because the whole system runs on the assumption that most people won't ever ask for delivery. It's like a bank. Banks don't keep all your deposits in cash in the vault. They lend most of it out. Same idea. The paper market operates on leverage, on the belief that only a small percentage will ever convert paper into physical. But what happens when industrial demand keeps rising and more people start questioning whether their paper claims are actually backed? That's the tension building right now. It's not about a crash, it's about a structural imbalance that's getting harder to ignore. Let me give you a real example of how this plays out. A few years back, there was a moment when small investors started buying physical silver in huge volumes. Coin dealers ran out. Premiums spiked. Wait times went from days to months. But here's what's wild. During that same period, paper silver prices barely moved. How does that make sense? High demand, limited supply, but prices stayed flat. Because the paper market, where price gets set, wasn't reflecting what was actually happening in the physical world. That disconnect, that's the gap we're talking about. And it's not a one-time thing. It keeps happening. Industrial users, they need physical delivery. They can't settle in cash. So when they put in orders and supplies tight, the real market starts showing strain. But the paper market, it can keep trading like everything's normal because it doesn't need the metal right now. Here's the thing about demand shocks. They don't announce themselves. You don't get a warning that says, hey, next month there's going to be a supply crunch. It builds quietly. Industrial orders stack up. Refineries run at capacity. Vault inventories tick down. And all the while, paper contracts keep getting written, keep getting traded, keep getting rolled over. The paper market has a feature called open interest. That's basically the number of active contracts out there. And open interest in silver, it's been historically high. Now think about what that means. Tons of contracts, tons of claims on silver that hasn't been delivered yet. And underneath all that, the actual pool of available physical metal, that's not infinite. It's a finite resource getting pulled in multiple directions. So when we talk about a growing gap, this is what we mean. On one side, you've got paper claims expanding. On the other side, you've got real supply getting tighter because industrial demand isn't slowing down. And in the middle, you've got a price mechanism that's tied more to paper trading than physical reality. That's the imbalance. Now here's where most people get it wrong. They think this means silver's going to suddenly shoot up or collapse overnight. That's not how it works. What actually happens is volatility increases. You start seeing bigger swings. Premiums for physical metal versus paper start widening. Delivery delays get longer. These are the real signals, not some dramatic price explosion. Major institutions, they see this. They track vault levels, delivery requests, refinery output. And when those numbers start looking sketchy, behavior shifts. Not because of panic, because of math. If you re-holding a paper position and you not sure the metal is actually there if you need it, that changes your risk calculation. And this affects more than just silver traders. Silver is used in so much manufacturing that when supply tightens, it creates ripple effects. Higher input costs for solar companies, delays in electronics production, price pressure across multiple industries. It's not isolated. The gap between paper and physical, it shows up in unexpected places. History shows us how this plays out. There have been multiple moments where physical silver got tight and the market had to adjust. Sometimes it's a price move. Sometimes it's premium expansion. Sometimes it's just longer wait times. But the pattern's consistent. When paper claims outpace physical availability, something gives. The question isn't if, it's when and how. And here's the kicker. The paper market doesn't have to care about industrial demand until delivery becomes an issue. So you can have this situation where industrial users are scrambling for metal, paying premiums, dealing with delays, while paper traders are just watching charts and trading technicals. Two different worlds, same asset. This is why the gap matters. Because eventually, those two worlds collide. And when they do, the adjustment isn't pretty. It shows up as volatility, as premium spikes, as delivery failures, as industrial users securing long-term supply contracts at higher prices. The market finds a way to balance, but the transition, that's where the stress is. So where does this leave us? The gap between paper silver and real supply, it's not closing. If anything, it's widening. Industrial demand's not slowing down. Paper trading's not shrinking. And the physical supply that connects them, that's getting tighter. Something in that equation has to adjust. And this is why the next supply stress in silver never looks obvious until it's already happening. Because the paper market hides the strain right up until the moment it can't anymore.